Hello, and welcome back to another episode of How To with Ziad. Last time I messed up. This is our 6th episode, and we're so excited to continue doing these with you. Today, we're going to be talking about taxes and how to save money on your taxes when investing. So right now, I'm adding on Ziad, who is going to give us a little brief introduction of what we'll be talking about today. Oh, let me scoot up back here. I'm a little close.
Hi Mia, how's it going?
Good, how are you doing?
I am doing well, doing well. Just to talk through a little bit of what we're talking about today, we wanted to go over the how to save money on taxes while you're investing. Obviously, we encourage all of our clients to invest, and with that, there are tax situations that we have to account for that. And a part of our job as advisors is to help make sure that you're also saving as much money on taxes as possible while getting your money working harder for you. And so just want to say first and foremost, we aren't specific tax professionals here, right? If you do have specified tax advice, seek your CPA. I think a lot of people, they generally, when they think about saving money, they think about saving on taxes. And so that's why outside of advisors, CPAs are one of the most trusted people in a person's financial life. And so happy to talk about this, really excited.
Yes. And with that being said, everything that we'll be talking about today is really just general educational advice. It's not supposed to be taken as advice. This is really just supposed to be a general conversation about how you can save on taxes. So please contact your financial advisor if you have any questions about your specific situation. Am I connected here? It was disconnected for a second.
Yeah, I think we're good. I think I might have had a little issue on my end, but looks like we're good to go.
No worries. Okay, well, let's jump into it then. A lot of us are aware of income taxes, but what people don't really talk about is capital gain taxes. So I know that we continuously stress the importance of investing, but just because we're investing doesn't mean that we aren't paying taxes.
Yeah, that's exactly right. When we don't get away with taxes when it comes to getting our money growing for us, the government isn't just letting us avoid that. They are taking a cut of that for themselves, and so it's something to be cognizant of as you invest.
Yes. So can you talk through maybe the difference between short-term and long-term capital gains taxes?
Yeah. So basically, there are two different kinds of ways you can get taxed on your investments. Short term is if you are buying and holding an investment for a short period of time. And so the time period that signifies short-term capital gains tax is within 1 year. So if you buy an investment and sell it before holding it for a year, you are subject to short-term capital gains tax rates. These actually aren't any different than your normal income tax rates. And so the reason we stress long-term investing is because of these longer-term capital gains rates, which are a lot more favorable towards a person, towards an investor. So if you buy and hold your investment for longer than a year, then you're subject to these lower capital gains tax rates. And so just to give an idea of the outline here, if you're single, you make less than $40,000 a year, you're paying 0% on any gains you make on your investments as long as you hold it over than a year. If you're making above $40,000, between $40,000 and $440,000, you're only paying 15% on the gains that you have with those long-term, if you're holding it long-term, and then any more than 440,000, you're paying only 20% on those gains. And this is obviously federal taxes. There's different state income taxes to be aware of depending on where you live. But as you can see, a lot more favorable than your normal income tax rates. And so definitely something to keep in mind as you invest is the idea of buying and holding for longer to take advantage of that.
So we are definitely encouraged to hold our investments for longer.
Yes, exactly.
Okay. And, we pay taxes on the gains, but if we lose money on our investments, then there's no gains to pay taxes on. What added benefit does this add to the investor?
Yeah, obviously we don't want to plan for a loss when it comes to investing, but it happens. The investments are subject to risk and go up and fluctuate up and down. But if you do have a loss and end up selling your investment at a loss, you can actually take those losses and write them off against your gains. So just to give you an example, say you had, $5,000 in gains that you realized for the year, and you sold an investment at $1,000 loss. rather than paying capital gains tax on that entire $5,000, you can take that $1,000, write it off against it. So you're only liable for $4,000 in capital gains taxes. So that's really huge to help make sure that you are limiting your tax liability.
That's really good for our viewers to know. And I know that we actually take advantage of here with our portfolio, selling at a loss sometimes to reduce taxes. Can you talk more about how we do this at GK?
Yeah, so we like to employ a strategy that we call tax loss harvesting. So the idea behind this is that we are, generally our overall portfolios, they might be positive, or they usually are positive, but what happens is some of the individual positions within our portfolios are actually trading at a loss. And so what we'll do is we'll sell that investment, realize the loss, and if we like staying in that industry, we'll buy something similar to keep the exposure in that industry or that position, and then with that loss, we'll write it off against any gains to decrease our client's tax liability. Just something to note, with this write-off, you can only write off up to $3,000 of losses against your gains every year. But if you accumulate more than that, then that just rolls over to the next year. And so you still have that on file. If you do have an up year, and you realize a loss of more than $3,000, you can just use it in another year instead. And so definitely something that we like to take advantage of just to help, basically maximize every dollar that we can for our clients.
Awesome. So to summarize tax loss harvesting, the overall portfolio can be up, but there are individual positions that didn't do well. So then you sell those to minimize taxes.
Exactly. And so, yeah.
So what are some other strategies that you use to save on taxes?
One other strategy that we use is called we rebalance our clients' portfolios. And so saving on taxes is kind of an added benefit to this. The major point of this strategy is to keep in the allocation that we worked with our clients on previously, or had planned for our clients. Say we work with a client, they want to invest a little more conservatively. They're in 50% stocks and 50% bonds. Well, when we invest in that portfolio, the prices change and the values of those investments change. And so things can get a little skewed. Say stocks increase tremendously like the past few months, then we're going to have a much higher percentage in stocks and less in bonds. And so when we rebalance, we're basically selling some stocks, really, taking profits from these positions that are positive, and then using that to buy bonds to then get back to that allocation that we had agreed upon with our clients. And so it's great to make sure that we're sticking to our investment plan, but how it helps with taxes is we're able to take the tax liability of these gains and spread them out over time. You think about when you invest, if you bought an investment and held it for 20 to 30 years and it grew a tremendous amount, and whenever you go to sell it, if you sell that entire position, then you're due for a massive tax bill. And sometimes this bill can be so large that you can even jump tax brackets and owe even more on everything else. And so when you rebalance, you're selling those profits every year. And so you're paying taxes every year on those, but it's, you're spreading it out. So it ends up not being as much. You generally avoid that scenario where you are jumping tax brackets tremendously like that. And so it helps our clients as well to stay in a healthy position when it comes to taxes.
Definitely. And then outside of investment strategies, there's also tax efficient accounts such as, IRAs and 401ks and 529s. So let's talk through these, and let's start with retirement accounts. What are some of the tax benefits of those?
Yeah. So when we start talking about retirement accounts, there's generally the two most common out there are 401k and an IRA. Just to talk through the difference of those, with a 401k, that's set up through your work. And so your employer is providing a match generally, which is an added benefit. The investment options in there are a bit limited, but it's automatically taken from your paycheck. It's really easy to make automatic. You have that benefit from your employer. An IRA, on the other hand, is set up just as an individual. So you set that up on your own. Any contributions you make, there is no match like that, but you have complete flexibility on what you can invest in. And so it's great if you want to invest in certain positions rather than the ones that are selected for you, choosing from a selection. The big thing to note here is the difference between your traditional contribution versus your Roth contribution. So when you contribute into a 401k or an IRA traditionally, what happens is that you don't pay taxes when you contribute. Basically, when you make contributions, you're contributing pre-tax dollars. You're actually getting a deduction for the year. So when you think about that, when you contribute, you're paying less taxes the year that you contribute. That money is going to grow tax deferred, so you won't be paying any taxes on the growth. But once you withdraw that money, that is when you have to pay taxes on it. Now, Roth, on the other hand, is the opposite. And so you pay the taxes up front. And so you don't get to pay less taxes the year that you contribute. But as long as you hold that money in your account until you're 60 years old, that money is going to grow tax-free for the rest of your life. This is huge, especially when you're younger. This is where you want to contribute to that Roth option. Those are the two highlights. It really just depends on your situation, on what's better for you.
Yeah, so that's a lot of information. So let's just summarize it for our viewers. The important thing that is that if you're in a lower tax bracket, you want to be contributing to the Roth option. While if you're in a higher tax bracket, the traditional makes a lot more sense.
Yeah, exactly. I just want to give a shout out to Andrew Vargas. Appreciate that. Appreciate the love. Definitely great job starting that Roth IRA and contributing. I think especially as a younger professional, you have to be doing that to get ahead.
Yes, and then also he mentioned, if we can discuss 1031 exchange is another day. That'd be awesome.
Definitely.
And I agree.
Yeah.
That's definitely something that we could go over in the future. And I don't think that we mentioned this at the beginning, but if you do have questions while we're having this conversation, please send them in the comments, and also just send us suggestions always of what you want us to be talking about next time.
Yeah, most definitely.
Moving forward, there's also SEP IRAs, which are simplified employee pensions for self-employed and for small business owners. Are generally easier to administer. Can you walk us through some of the tax advantages of SEP IRAs?
Yeah, like you said, these are meant for these small business owners. Generally, it's for someone who's running their business on their own, who doesn't have employees. The benefits of a SEP IRA is basically you can take the profits from your business and you can automatically contribute that into an IRA or an individual retirement account for yourself. The major difference here is that you can contribute a lot more than a regular IRA. And so if you think about a Roth IRA or a traditional IRA, you can only contribute $6,000 a year into those accounts. With a SEP IRA, you can contribute up to $56,000 a year, which is a lot more. Generally, these small business owners, you don't have access to a 401k or those other kind of retirement accounts. And so this is a great option for you. But I want to stress that if you do have employees on working under you, that if you open a SEP IRA, any percentage of the profits that you make that you contribute towards yourself, you have to contribute to each employee as well. And so it's not great if you have a few employees. If you do have a few employees, there's other retirement options out there. Generally, a 401k is fine. But if you're just running your own business, it's just you running the show, then SEP IRA is definitely a great option. The contributions in there are going to be pre-tax contributions. So you'll get the deduction for the year. It'll be tax deferred, but then you will have to pay taxes at retirement.
And you mentioned holding money in your account until you're 60 years old. That's a very important age when it comes to retirement planning. Can you talk about why? Yeah,
so with any of these retirement accounts, 60 years old, technically the age is 59 and a half is the golden age. If you pull out any money before contributing into before hitting that age, before reaching 59 and a half, then you have to pay regular ordinary income taxes plus a 10% tax penalty on top. And so that's a big hit on those investments. The whole point of this IG Live is to save money on taxes. So we definitely recommend avoiding that. And so, 59 and a half is the age that you want to be shooting for. You want these accounts are specifically for retirement. And so that penalty is just to incentivize you to keep it there for that.
Okay, so let's transition over to saving for college. Tuition rates are rising at about twice the general inflation rate, give or take, and private schools can be as much as $70,000 or more now. We talked about this a little bit in one of our previous episodes where we talked about student loans, which you should definitely go check out if you haven't seen yet. But when we're talking about saving for college and what account is best, we commonly recommend 529s as opposed to covered LESAs because you're able to contribute more. But covered Ls can still be a viable option for some clients. Let's talk about the advantages of 529s.
So with a 529, basically these are accounts that are dedicated specifically towards education, like you said. When you contribute into a 529, you are getting a tax deduction on your contributions. And as long as that money is being used for educational expenses, whether that be tuition, room and board, supplies, anything along the lines of that, those qualified expenses, it's going to be growing tax-free as well. And so like you said, tuition rates have been raising at such a high rate. You need to be investing, not just saving, to be able to cover, educational expenses for your kids. And so 529s are a great way to do so. Big things to note with the 529 is that there is no limit on what you can contribute. You can contribute as much as you'd like, but if you contribute more than $15,000 a year, then you have the potential to incur gift taxes on anything additional. And so as an individual, if you want to contribute, you wanted to shoot for 15,000 a year, that's a great number. Thankfully, that number is for each individual contributing into the account. So if you're two parents contributing into a 529, each parent can contribute $15,000 each. And so then that combines for $30,000 instead. The big thing with the 529 also, though, is that there is limited investment options in there. They are state-sponsored plans, so depending on the state that you work with or the plan that you work with, you have to choose from a certain group of funds rather than having complete flexibility over your investment.
Right. So to speak more on the gift tax of 529s, you're able to make a lump sum contribution that's up to 5 times the general gift tax exclusion. So that's $75,000.
Mm-hmm.
Which that could be very beneficial for our clients.
Mm-hmm. Most definitely. And this is with 529 specifically. Like you said, you can basically forward 5 years of contributions into a 529. And so 15,000 for 5 years, $75,000 or less if you'd like. And then get that massive deduction for that 1 year. And then you just won't be able to contribute anymore for the years following. But that's always a great option, especially for our clients who are in higher tax brackets, to get that massive tax deduction while still being able to help provide for their kids' college.
Awesome. And are 529s only for college savings?
So yes, they are. They are only, well, not just for college savings. You can use it they just recently got qualified for high school expenses as well. But they're for educational savings specifically. And so you want to, when you think about 529s, you just want to think about education.
Right. And there's also a tax penalty for ineligible expenses. So if you need to use the money for something other than your college expenses, what's the penalty like for 529s?
Yeah, it's the same as the retirement account. It is that 10% on top of whatever ordinary income that you would normally pay. And so, with these accounts, they're all specifically classified for certain areas. And so if you're using it for something that it's not classified for, then you're generally going to end up seeing a 10% additional tax penalty.
Great. Okay, so I feel like we've covered 529s pretty well. So let's move on to covered L ESAs and how they differ and who are they appropriate for.
Yeah, covered L ESA was basically the original educational savings account. And so before 529s existed, most people were contributing into covered Ls. The 529s are just significantly better in basically almost every category in terms of how much you can contribute, income limits, all that kind of stuff. Just to walk through what a covered L ESA, the details of it. You are contributing after tax dollars, so you do not get a deduction on your contributions. That money is still growing tax deferred and tax free as long as you use it for qualified educational expenses. The real issue here is that you can only contribute $2,000 a year per child. And so if you had, say, parents and 2 grandparents who are all looking to max out contributions for the year, compare 529 to a covered L. 529, they can contribute up to $60,000 without having to deal with gift taxes. They can even contribute more. But with a covered L, you can only contribute $2,000 between the 4 of them. And so it's not very flexible in terms of how much you can contribute, especially with tuition being so high. $2,000 a year just isn't a lot. Beyond that, there's also income limits. And so if you are single and you make more than $110,000 a year, or if you're married making more than $220,000 a year, you cannot contribute into a Coverdell ESA either. The major benefit of a Coverdell compared to a 529 is just you have unlimited flexibility on what you want to invest in. So if you're looking to make a very aggressive investment, you can, but generally 529s are just the better option by far.
And then similar to 529s, there are tax penalties on Coverdell ESAs as well.
Yeah, exactly. Same 10% tax penalty. Also, the Coverdell, if the child or the beneficiary of the Coverdell, once they hit 30 years old, you have to withdraw that money no matter what. And with that withdrawal, if it's not used for education, then you still have to incur that 10% tax penalty.
Right. So there really is so much more that we could talk about regarding taxes. We've really just touched the surface. We could go on. We could talk about HSAs, donor advised accounts.
Mm-hmm.
So we may have to continue this on another episode.
Yeah.
But if you have any questions right now that we can answer, shoot them our way. I think I saw one up here too. I missed it. Oh. Okay, as someone who is currently in a lower tax bracket, should I be looking to buy and sell 1250 assets when possible in order to take advantage of my current rate?
I would just say with assets in general, with the lower tax bracket, definitely take advantage of that. If you have the capability to make investments and sell them at that lower rate, do so. But again, like when you're thinking about investing in general, you want to think about it for the long term, not necessarily from a, buy 1 month, sell the other month kind of basis. It's really tough to consistently find returns when it comes to investing in that manner. If you're in a low rate, definitely capitalize it, Jake. Yeah.
Awesome. Well, Thank you again for joining us with another episode of How to with Ziad. We will continue next week. And please DM us any topics that you would like us to talk about. Maybe we'll just continue this tax one because as I said, we could keep going for quite a while.
Yeah, there's tons of different tax accounts that we can talk about, tax situations. Obviously, like I said before, seek a tax professional if you're looking for specified tax help. Talk to us as an advisor for financial help. We're here to help talk through the big picture, make sure everything fits in your overall financial plan. But yeah, happy to help.
Absolutely. And if you missed the first part of our live, then you can go back and watch it on our IGTV, or you can check it out on YouTube. We'll be uploading it to there afterwards. Contact Ziad if you have questions. In the meantime, his email is ziad@gerberkawasaki.com. And we will see you next week at 1 or 1:30.
Yeah. Thursday, early afternoon. We'll see you there.
Early afternoon. We will see you. All right.
All right. Have a good week, everyone.
Thank you for joining us. Bye, Ziad.
Bye.